seeing it fight and battle and now holding, around 2,300 or just over 2,300 is great for gold. Same thing with silver as we're moving up to see, holding and fighting for $27.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics as we are into another week of silver and gold trading, which we're recording on Monday. Unfortunately, there's some good news to start off the week as we have a rally in both gold and silver following about a week or two of a correction, which followed a rather stunning rally over the past 2 months that preceded that. So, a lot happening and good to see things on the positive side. And fortunately, to dig in and take a look through everything that's happening, I have Steve Cope of Silver Viper Minerals joining me once again on the show. And Steve, great to have you back on here as always. And how are you doing today?
I'm doing well, Chris. It's always good to be back on the show, and we'll see what we can come up with for where gold and silver are going.
Yeah, and we're recording Monday afternoon at just about noon Eastern time. And as I mentioned, silver, good start to the week, up $1 already, which if we take a look back, we can see quite a couple month period here. Again, going back to mid-February, we're down to 22 bucks. Got pretty close to 30 a few weeks ago. I'm sure everyone remembers that Friday. The morning was a little more exciting than the afternoon when the prices came tumbling down. A little bit of a correction, similar pattern in gold, as you can see here, under $2,000 not too long ago. Rallied quite a bit, came back down. Steve, I would think in some sense that the fact that we saw correction after the size and magnitude of the rally that we did, probably a good thing when you think about how these usually do not go up in a straight line, and also encouraging to see that we're seeing that reverse and a nice move higher to start the week off here. And before we dig into some of the other things happening, I would love to hear any thoughts you have on what we've seen in the past day and following what we've seen over those past 2 months.
Yeah, I mean, again, I'm you never real. I mean, it feels good to see something going straight up, but it's when you talk about gold and silver, our on a macro scale, like our runs are long. Like our bull markets are 8 to 12 years when you look at the past cycles. So what we want to see is that slow rise and just keep moving up, and then have these periods of consolidation, seeing it fight and battle, and now holding around 2,300 or just over 2,300 is great for gold. Same thing with silver as we're moving up to see, holding and fighting for $27, and trying to sit in that range and hover and hold there is great. That's a healthy in a bull market to see these consolidation periods, of a week, 2 weeks, even month, seeing it hold and fight, and that you're setting kind of a new bar and then moving up from there and then consolidate again, move up, consolidate. And you want to see that happening over years. And so for how aggressive of a run up we've had over the last couple months, and now to see it still hanging on to a lot, like a big chunk of those gains and consolidating, is very healthy and really promising for the market moving forward.
And Steve, obviously, in the past couple of weeks, I've seen a lot of articles or Twitter notes from various people suggesting that we now are in the beginning of a longer term bull market in both gold and silver. Certainly, as we'll dig into in just a minute, I think there are reasons to believe that could well be the case, but curious if you had any strong views. Again, could the price go lower from here? Obviously, that's certainly possible, and the timing on how these things play out. But based on everything that you're seeing, any strong thoughts either way on whether we might finally be in the beginning of something, perhaps like what we saw from 2000 to 2011, or in gold, really from 2000 to 2024? Do you think we have finally entered that new bull market?
Yeah, I think when, obviously we're gonna have to look back, 10, 12 years from now, and that'll be the real indicator. But I think we probably are, kind of a year, 2 years into the start of a bull market. This is the start of our first kind of breakout of it, but we've been getting healthier. We've obviously, the one kind of caveat to the gold market the last couple of years was the rapid, increases in interest rates, which I think kind of stalled out the start of a bull market that we were in. But on a macro scale, I still think you look back and say that the bull market started probably a couple of years ago. But that means, if you look at the past two major cycles, I mean, that would mean we've got, 8, 10 years left of a bull market. And and it feels like that. I mean, it feels like people are paying attention, but still, hesitant to dip their feet in. You're getting the retail investors a little bit more excited and coming in, and you're seeing some inflows finally into the funds, which is obviously another great sign that and it's the start of inflows. It's not a massive amount of inflows yet, which again are all signs that we're at the start of something. We through these cycles, it's those funds that finance the companies, and they haven't been able to do it over the last 2 years. And now finally, over the last, call it 6 weeks to 2 months, you've started to see some of those funds be able to finance on a smaller scale some of the companies. And again, it's already coming down to the smaller size companies. So it's definitely a great start for the sector. It very much feels very different than it has, as of 2 years ago, a year ago. This does feel like the start of something. We're building momentum, and we're doing it and seeing metals prices rise into a market where we're pushing off, rate cuts, which is huge. We're consolidating, we're showing strength when the market expectations now are potentially for rate cuts towards the end of the year or into 2025. So to still see metals prices performing, I mean, it feels like everything's kind of coming to a head, and people invested in the space should finally do really well and over a long period of time.
Yeah, certainly quite a change from when we were doing these calls back in January, and we heard the calls for 6, 7 rate cuts, and that has changed a bit. And we will get to some of Jerome Powell's commentary from last week. Although one thing that you and I have talked a little bit about, although as I look at the things that are happening, the level of inflation we have already, then tack on the debt supply, that wonder if we've crossed the point where it's, you can lower interest rates, you can raise interest rates, and you're still going to get inflation. While it makes it trickier for the miners, if we're already at a break-even cost for a lot of the silver miners now, that level is just going to continue rising. And despite the short-term fluctuations that we see from how things are being traded on the COMEX, the price has usually not stayed below the cost of production for an extended period of time. And if we're at 23 to 25 for a handful of the primaries already, that price is really just going to be getting pushed up as we go forward. And obviously some people have some extreme inflation expectations when you look at some of the things we're facing next 5, 10, 20 years. Still, that is going to be pushing the silver price higher as we go forward. You say that's appropriate to say?
Yeah, I mean, I would take it a step further. I think 23 to 25, the primary silvers aren't making money unless they've got a byproduct that's making a bunch of money to make it that cost. If it was 100% owned silver mine, or 100% silver mine with no byproducts, like, it was 23 to 25 10 years ago. Granted, some of the companies were forced to bring, their costs down, but like a company like First Majestic had a $25 average silver cost 10 years ago. And that's why we've talked about in the past, why a lot of those silver companies became gold companies. Pan American Silver is 80% gold production now. It used to be the number two, at one point briefly was the number one silver producer in the world. But there's no money to be made in silver and primary silver deposits. So they started accumulating gold deposits. So when you've got gold at 2,300, you're making a lot of money on the gold side of things. The silver side, I mean, I think it's why a lot of the market has always said $30 was a big number, because to me, especially on newer silver deposits, you're going to need $30 silver to make it go, to justify building in and getting a payback period just to start. And then even then, hopefully you have a byproduct that can make you a bunch of money on the side and bring those costs down. But silver needs to be a lot higher. And then we've talked about it before, and we'll talk about it again. But we talk about the supply of silver and the above ground supply of silver and all the new demand, and how the increase of demand coming forward with solar panels and electric cars and everything else that goes in, anything else electronic that needs silver. And it has to go higher, because you need to have those costs move up to start having companies make money off of producing silver. So we'll see. But like, again, I would take it even further. I think 23 to 25 is bullish if a lot of them are making, if you think they're breaking even. I know a lot of them report an all-in sustaining cost, and they'll say that, but an all-in sustaining cost is better than the old school just regular cash cost number, but it's still not the cost for the company to stay in business. That's the cost on that mine, but then it doesn't factor in the overhead of head office and G&A and other things for the company just to make money. And so I always I've laughed through the years when I see, the mining companies, and they report an all-in sustaining costs, and then I see their cash position going down quarter by quarter. And it's like, well, if that was actually your cost for a company to function, then you should be printing cash at these prices, and you're not. Your cash position goes down because you're not factoring in, expiration on your project, maybe to replace reserves, or even different people still even calculate all-in sustaining costs differently. And I go back to when I worked for a producer, and there was a liner for the crushers, and they moved the CFO moved the cost of the replacing those liners that were constantly being worn down and being replaced every quarter. And moving it changed our gold cash cost number by like $20 an ounce. And it just, all of a sudden, the way the accounting worked, you didn't have to, our cash cost came down. Well, the cost of doing business didn't come down. You still had to replace the cost of the liners, and you still, it was still a business cost, but it wasn't reflected in the all-in sustaining or your regular cash cost number. You can, accountants are able to move certain things around. So I always like to look, and when it comes to that, is look at these silver producers. Okay, we've got record revenues. This is our all-in sustaining costs. This was our cash position last quarter. This is our cash position this quarter. Are they making money? Is that balance sheet going up? If the cash didn't go up, is it because they reinvested somewhere else in something that was going to add value? Fine, or buy an asset. But if nothing changed and the cash position is coming down, or it's not going up by the ratio of what the all-in sustaining cost is, you have to look at what the actual cost of the business is to run, and no one reports that. Other than you can probably see it in the cash number of the producers. So it's a tricky number, but I would argue that it is a much higher number for primary silver producers outside of some of the special, like obviously extreme. There are exceptions with extremely high grades that can make it, but your average silver producer across their various assets, I believe, would need probably $30 silver if it was all primary silver deposits to make it go and break even and make a little bit of money.
Yeah, and I know that makes it a little tricky where the all-in sustaining cost doesn't always reflect everything that it's actually costing on a true accounting basis. Anything you could pass along for people that are trying to get a good gauge of what it's actually costing the companies to get the metal out of the ground? You mentioned a few factors, but anything else that people would want to look at when they're looking at a miner and trying to get a more appropriate measure of what that break even level actually is?
Yeah, I mean, for me, the best is the cash position. Just keep an eye when they put out their financials, look at the cash position. Obviously, another one for the producers. If a producer's reporting that it's making all sorts of money, I want to see the dividends increasing if they pay a dividend. Or, I would focus on ones that are paying a dividend, because obviously if you're just going to give the money back to the shareholders through a dividend, you should be making money as a company. Hopefully they're not paying out dividends and then losing money quarter by quarter and getting themselves in further trouble. So I would focus on the dividend paying producers, and then see, if everything is as healthy as they say and their revenues are increasing, then you want to see that dividend moving up quarter by quarter to reflect, a percentage of the profit that they're making. Obviously they want to keep some for the company, because the producers should be wanting to grow and potentially use some of that cash towards new acquisitions and other things. But if your revenues and your profits are increasing, then the dividend should increase at least at a similar percentage to what it's at before. But those are the kind of things I would key on as an investor looking at the producers, is make sure it's actually making money. If they're saying that, and if it's not, then why? Is there something going on? Like I remember, dealing with Agnico Eagle, and for the first time in their history, when they were building the mines and none of it was, they were cash flow negative, but there was a reason for that. And it's obviously Agnico is a phenomenal company and very well run, but there's a justification. They spent 2.3 billion building two mines up and none of it. So that, there was a reason that cash was being outlaid and it wasn't making money. But other times you'll see companies, we got record revenues, we got, and our all sustaining cost is this, and I look at their cash position and they haven't done anything separate and their cash has come down. And so I just from having been around companies like that and seeing it, and it's the accounting practices. Obviously there's outside accountants and auditors that are all approve, the methods that they're doing, but and it is a dramatic improvement over what companies used to just report as a cash cost, because that number was like the Wild West. They would report negative cash costs and the company would be losing money. It was like, what is happening here? It made no sense. So, but that was because they had all these byproducts that they would write off, and then but you still dig into all the things that weren't included in it, and the company wouldn't be making any capital. So I would really focus on cash position and focus, if you're looking at the producers, focus on producers that pay a dividend, and you want to see that dividend increasing as they should be making more money.
Alrighty, appreciate that, and hopefully that's helpful for people who are watching and listening, because not always the easiest thing to calculate. So now moving back to the demand side of some of the things that could be driving our metals going forward. Obviously, you mentioned earlier that is interesting to think when we do finally get interest rate cuts, if we do get them. Jerome Powell was talking about the possibility of a hike, said he didn't see that being likely yet. We'll leave that aside for now. Obviously, on the show here, I talk quite a bit about the de-dollarization that's going on, because I think that's an important part of it. It's an important part that I think led, even before this was a theme that we called de-dollarization. For decades, people were looking at the finances and realizing there's something inequitable about this system. And now we see here on Bloomberg de-dollarization happening at a stunning pace. Greenback's share in global reserves slid last year at 10 times of the average speed of the past 2 decades, as a number of countries look for alternatives after Russia's invasion of Ukraine triggered sanctions. Did happen right around the time we started seeing the central banks set records for the amount of gold purchased. And I think about all the things that have happened in these past 2 years, and then to see that U.S. threatening to sanction China if they were involved in Russia war efforts. Russia responded by sanctioning 440 million of J.P. Morgan's assets. And in case anyone thought maybe that would calm things down, here we see last week, U.S. issues hundreds of sanctions targeting Russia, takes aim at Chinese. So it feels to me that a lot of the issues that have been driving what we've seen the past 2 years, they're not getting better. And even aside from the pricing, you're talking about a lot of countries, and when you mentioned the inflation earlier, that are resource rich, that are producing oil, that are producing commodities. Curious if you have any thoughts on how this plays out. If now we're adding a sanction war on top of this, here's Trump saying that if he's elected, he's going to penalize countries that have been de-dollarizing, which I imagine that would probably have the possibility of making them want to accelerate those efforts. But do you think this is going to be another driver of what we're seeing in gold, and especially continuing to happen going forward?
Yeah, I think you're right. I think it's been the biggest driver of everything over the last couple of years of where we're seeing, and like you say, those Feds piling up gold at record rates. And a lot of it is it's East versus West. This is the Eastern world versus the Western world and the different mindsets. And if Trump does that, you're just driving countries that they would do that to join. And when we start talking about the BRICS currency that's backed by gold, and you're just going to drive countries to start doing trade and saying, you know what, we don't need the U.S. We don't need the Western world. If China's welcoming us with open arms in Russia, and and they're going to take advantage of that. But these countries, they'll just say, we'll go to them because they're going to be more helpful, and we don't care about your sanctions. And you've got large enough populations in China, India, Russia to start. And like you say, these are resource-rich countries. It's one of my biggest complaints about Canada and the U.S. is we do such a disservice to ourselves of not producing and keeping things in house and making sure that we've got manufacturing issues, especially in Canada. I mean, it's just we don't even process our own oil. We send it to the US and then buy it back at a premium. Like it's just, it doesn't make any sense. These countries should be setting themselves up to be self-sufficient, because you shouldn't be able to be bullied by some of these bigger countries that, are saying, oh, you're not going to use our currency anymore. Well, we're going to sanction you for that. Like that's absurd. And it's when you're kind of grasping at straws as you're losing your, power as the world's reserve currency. Trade stops happening in your currency. It starts happening in gold or a gold-backed currency. Oil, gas is being purchased with other currencies. That's going to become the new way, and it's and maybe the West is separate from that, but you lose your power because you rely on all these countries to accumulate all your stuff. And who's going to buy U.S. Treasury bills? I mean, these guys have all moved on from them. So you're trying to pass that along to your big companies and private entities within your company to buy, or within your country to buy all of your assets to support this massive debt that's growing at record rates every day. and you're running out of people that are going to do that. And then so then you've got to have interest rates go up on your T-bills to entice people to take the risk. Well, that doesn't work, because then your debt just costing you more and more in debt to pay off your debt, and it's a death spiral. So I mean, that's what people are seeing on the writing on the wall, and why they're starting to look elsewhere.
I think that's pretty well phrased. It is the death spiral where,
Yeah.
I mean, we can sit here and talk about it, look at different data points, yet in the end, they're in a pretty non-enviable position. And yeah, I think that has a lot to do with why you see. And here we have, this was slightly a record for first quarter purchases. So 2024 off to a strong start for many of the reasons that I think you just rather eloquently pointed out. Perhaps a little bit less eloquently, let's take a look at what Jerome
Inflation.
Powell had to say last week during his press conference. I know you're sometimes I watch the Jerome Powell press conferences and I picture you in the back of my mind. Imagine Steve bending his head on the desk. But we're going to give you a little snippet here and see what he had to say in terms of inflation.
Right now we have very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
So Steve, he's not seeing the stagger, the inflation. He said that he thought growth could come down from that 3+% range, which actually did before he made that statement. Here was a couple of weeks ago, growth slowed to 1.6%. Talked about inflation under 3%, although the personal consumption expenditures index that they use for those calculations rose at 3.4% annualized for the quarter. Here's unemployment. You can see back here in May of last year. So we're a year later, half percentage point higher. And in terms of inflation, here's a few handy charts that I found where you can see 3-month change and 6-month change in core CPI reaccelerating. As you see on the end there, here is super core inflation, stripping out energy, food, and rent. You can see that's going up quite a bit. And then here's the 3 and 6-month change in core PCE. Are you seeing the stag or the inflation, Steve?
I mean, the inflation's always there. And we've talked about this from the beginning. Like, the raising rates, the type of inflation we have was never going to solve the problem. And especially doing it in the way they did to see if their raising rates would even do anything. They just went rapid fire. These things take a year, 2 years to play out, to actually see the results of what they're doing. And they went, record crazy on us on the market here, and just raise to the point where they were putting their banks at risk. Obviously we saw the defaults in the various banks, promising to bail them out with trillions of dollars to, you won't go out of business. But it's a disaster. It's an absolute tire fire, and we're feeling it. I mean, the inflation is still there. I mean, I feel like going to the grocery store every time and seeing, what my little basket of food that we're buying, for what $100 gets you at the grocery store. It's pathetic. So it's not going to go away. Whether you raise rates, lower rates right now, all those costs have been passed along, and people have been so hurt by the aggressive rate hikes that you have to see costs increasing, because for the companies to make, to deal with all these price increases, they've had to, people are demanding higher salaries and want to be paid more to keep the same level of livelihood. And the companies have tried to do some of that. And then they're just passing off the cost to the end user again. And it's, we talk about death spirals. It's the same process happening on playing in front of us there. Costs are going up and up and up and up. outpacing what people's incomes are doing, even though they want more. But then when people do get more, then the costs just go up more again. So it's another major issue. But whether they raise rates or cut rates, I don't think it's not gonna solve that issue.
Yeah, I think you summed that up well in our call today, where there's a handful of issues that I don't know whether a rate hike or rate cut necessarily solves. So what can I say? This is why we talk about silver and gold, and I think why you're seeing not just you and I talking about silver and gold, but new record gold prices, seeing new record amount of central bank purchasing, and seeing the effects of these things. At the same time, we're seeing new sanctions. So in case anyone wonders where we're coming from on this, there you have it. Although Steve, before we wrap up, would love to hear the latest on how things are coming along with Silver Viper. Obviously, you're in the middle of a financing with the goal of getting out drilling again, and perhaps we could start there and you could give us an update on how things are coming along.
Yeah, I mean it's been great to see some money on the market. We closed the first tranche for just over 2.1 million Canadian. Have a second tranche still open right now, and it'll be open for another couple weeks. And we've got some more money in that. We'd like to, try and fill it up to 4 million and get back to the market and start drilling the project aggressively. We can get back with less, but I'd like to run a proper, like 5,000-meter program to start with. And so yeah, we'd love for anyone who's interested to participate in that placement. It's a life placement here in Canada, so it's their free trading shares with a warrant. Yeah, I mean, if you're interested, please reach out to the company. But again, I mean, there's not a lot of quality silver gold assets out there. Our project is 60% gold, 40% silver. So even, in spite of where silver prices may be, where we would be a primary gold deposit with a silver byproduct, but it's a very large silver byproduct. And that really, and we've kind of built our main resource on the project around an open pit heap leach operation, which can operate at the lowest grades. It's your cheapest cost mining. When you take it into production, and we've got, a project that's sitting, at 2 or 3 times the grade of the existing mines in the state and what they're operating at and making money. So again, it's a great asset. It's one that we need to bring back, to prominence and get an active drill program going on again, looking to make new discoveries and grow that resource to the levels that we believe the project can be. And so again, if anyone's interested, yeah, please feel free to reach out. Or if you just want to talk about the project, again, you can reach out through all the contact details on the website as well.
Yeah, and one other note regarding the project. I know something you've mentioned in some of your presentations where you spoke with Quentin Hennig, who is obviously a well-known geologist. He told you that you're onto a gold carbonate metals-based system, and perhaps you could just explain for folks who might be hearing that for the first time what that means and what that indicates.
Yeah, so Quentin did a deep dive in our database. Obviously Quentin from his Newmont days and all of his experience around the world has an extensive database of knowledge. And he said he looked at our pathfinder elements, what our host minerals are, things that are associated anonymously with our, where we're getting our gold and silver assays. And he said, yeah, you're on a gold carbonate based metal system. And then when you have looked at our results, we have no carbonates, we have no base metals, and we have high grade gold and silver from surface down to 300 meters below. We're still in high grade gold and silver. But what he's talking about is the potential down below where we have our existing resource at El Ruby, the potential for one of these large systems deeper. And what would happen is it would be at a deeper contact between the host rocks. We have our mineralization sitting in a very favorable horizon. Below that, we have a package that sits in a rhyolite as your host mineralization. That's a tight rock that doesn't allow for the fluids when mineralization was happening to percolate out and make these big, broad, wide areas of mineralization with high grades. But when those fluids were coming up into the system, when they would have hit that contact below the rhyolite package and hit that rhyolite package, you would get this big blowout of mineralization where the fluids would disperse along that contact into the weaker rock below them, which in his model would be your kind of limey sediment package or your meta sediments. But even if it's not that, and it's another andesite package like where El Ruby is sitting in now, you're going to get a big, broad zone of mineralization. And what we see from time every so often in our drill core is we'll get these sulfide materials that the geologists can see have been blasted up from depth when this mineralization was happening. Everything was very active. And you'll get, a half meter with those sulfides in it. And those sulfides will have high grade gold and silver with the base metals that, Quentin's looking for associated with them. and you can see they've come from deeper in the system. So it's one of the models, and we did some geophysics and identified a very large, deep target right below El Ruby that we want to test in our drill program. And similar mines around the world become, 4 or 5+ million ounce gold deposits with high grade base metals and silver. So that, if we're onto something like that and we make that discovery, obviously that's, a game changer for us and for, our investors. And when you're trading as cheap as we are right now, coming into what we think is a long, broad gold and silver market, if you can make a discovery like that on the project, I mean, those are the type of discoveries that grab the market's attention and grab everyone's attention. So including the major miners, and everyone would want to get involved instantly. So again, I mean, there's the potential for that for our investors, and it's something as a company we've been just waiting very patiently to be able to have the finances to start testing that theory. But even beyond that, we have all these other targets along surface that we've been mapping and sampling and identifying over the last, year and a half, and that we're really excited and think near surface that we're going to be able to make some high grade discoveries in the breccia structures that we see around the project that are similar looking to El Ruby.
Yeah, and of course, that's in addition to perhaps ounces that could come online with the higher prices, something we talked about last time, and I'll link so that at the end of this call, if people would like to hear more about what Steve had to say about that last time, that'll come right your way as soon as we wrap up here. So, Steve, I know you've been, like you said, you've been waiting patiently, and certainly I think there's a lot to be excited about, especially to get out, do the drilling, and update the resource estimate. So I know you're working hard at that. And if people have questions, they can go to silverviperminerals.com and, of course, click the contact tab and get in touch with Steve or Alicia, who will be happy to give you more information about that. And Steve, I guess we will wrap up for today, but nice to see rally in silver to start the week. I mean, some of these developments that we're talking about aren't ideally nice to see, but I think at least help people to feel a little bit better about some of the reasons that they've gotten into silver and gold in the first place. And while it's not perhaps the ideal way we'd like to see the world working, I don't think we've seen the end of the increases in silver and gold, regardless of whether that's this year, next year, or the reasons for moving into the sector in the first place. My opinion is still very much intact. I think that's the same case with you, Steve.
Absolutely.
You're
No,
not
I
you're not
again,
selling your gold and mining shares and buying treasuries yet.
no, I'm still buying the physical product here. I can get it in wherever that is. Yeah, it's blood. Anyways, I
That
got a
helps.
lot of so no, I mean, again, this sector isn't, a lot of investors like, and are they've gotten excited about some of the other commodities, and they go on these flash runs of 6 months, 2 months, 1 month, and they see prices skyrocket and then come back down. Like your uranium run, some of the battery metals we've seen in lithium and other things, but gold and silver, like, and this is what investors need to remember. Like when gold and silver go on runs, they are long cycles. They aren't quick flash in the pan, straight up, straight down cycles. And when you're investing in this space, you have to do it with the long goal in mind. It's not trying to come into these stocks and day trade them and move in and out and just, take advantage. It's about being patient, sitting with your favorite picks, sitting, whether that's a producer, whether that's juniors, whether, there's pick where your comfort level is, whether it's the physical metal itself, but these are long-term investments. These are not meant to be short-term flipped, day traded, any of the other, stuff that you can do with blue chip stocks or do with other things that you think are going to run. But when you're in gold and silver, and especially if you're investing in the juniors or any of the companies, you need to do it with a long approach. And that the best investors in our space, that's where they make their money, is sitting there being patient with the juniors. Even if you invest in 10 and 8 of them will become worth nothing in this long cycle, those 2 that are going to be big wins are going to be 20, 30, 40x gains, especially from where prices have been diminished to now. And it doesn't matter if they're other ones, because you're going to make a fortune off of those 2 and with the rest. And that's the best investors in our space have understood that for a very long time. And so again, I mean, I think people that are getting involved now are going to do very well across the board with gold and silver companies, but do it patiently. Don't see, that share price move up 50%. Great, we went from 8 cents to 12 cents. Oh, I'm going to sell. That was a great profit. Like, that's the short-term thinking in our space. That, you're investing in this space for the big wins, and that's what people need to be patient and invest and ride along if you can afford along the way. Even if the share price doesn't jump right away, keep doubling down, or if with whatever income level or investment level that people have, average down or keep building your position slowly until the run happens. But you're in this space, you're watching these videos because you believe in what's coming, or you're certainly curious, about why people think that this big bear market is happening. And if you can get involved and you can be patient, investors are going to do very well in this industry over the next 8 to 10 years.
Well, I think that's pretty well said, and perhaps sometimes easier to say than do, yet I guess that's the target, and hopefully this call was helpful for people watching at home. So, Steve, we'll wrap up for today, but thanks as always for making some time, and we'll stay posted with you on how the financing and drilling plans come along. And again, if people want to get into contact, silverviperminerals.com. And Steve, we will see you again next month.
Thanks, Chris. Always a pleasure.